All right, welcome back to another episode of SaaS Buyers Club. I'm here with Matt Verlaque from SaaS Academy. How's it going, Matt?
Dude, it's going amazing. Thanks for having me on, man. I appreciate it.
Absolutely. And we're gonna talk today about the three things that SaaS founders need to know about building a sellable business. Is that right?
That's the plan, man. It's funny because in my first company, I didn't think about building a sellable business until I was ready to sell my business. I don't know if that resonates. So I never listened to this, but there was a lot of hurry up offense. And then you've probably worked through a bunch of deals with people, man. Have you seen that as well?
Oh no, never, bro. Everyone totally thinks about it. They don't wait until they actually want to sell their business. Oh yeah, man. I mean, I think one of the number one topics that we talk about on this show, and I actually love it because founders really do, I think, need to hear about it. So in
Yeah,
every episode, it does come
cool.
up in various different ways. So yeah, it's something that I think is really important. Repetition, is key. And
Yeah,
so having this conversation a thousand different ways, that a thousand different people, I think is incredibly helpful.
cool. I think like for me, the big idea was that building a business that's sellable is also a business that's awesome to run. I think that's part of it is I think people need a reason in their heads to justify like getting their shit together and getting things organized. But really it's like if you build with that end in mind, your business is going to be sick if you do it the right way and it's a lot more fun. And I think that people will sometimes sell a business. There's a variety of reasons someone sells a business, right? I mean, sometimes there's a great opportunity. That's cool. But like sometimes they're tired of it. Sometimes they've hit their complexity ceiling. Sometimes they're just stressed on money and want to take some chips off the table. And so I don't know. I think building a sellable business the right way at least gives you some staying power inside the company too. So you can sell it on your terms.
Yeah, it's crucial. And the other piece of the big idea, I think, too, is, oftentimes I was talking to another guest about this yesterday. Actually, Kevin McArdle was on
Yeah, yeah,
on
it's
the show
awesome.
yesterday. And what we were talking about was about how brokers and investment bankers often advise, okay, when you're starting to think about selling your business 2 years out, start to turn it into a package sellable business. But Kevin and I were like, no, screw that. Like from day one,
Day
like
one.
build your business as a sellable business.
Yeah, 100%, man. Cool. Yeah, agree. And Kevin's great. Like, if you're selling a business, you should go talk to Kevin because he's legit. He's the real deal. So, yeah. So, where do you want to go? Should I just give you kind of the hit list? We can talk about each point. I'd love your take too, or how do you want to do it?
For sure. Let's actually start with your background.
Cool.
Yeah. Who is Matt? Where does Matt come from? What have
Yeah,
you
yeah.
done? What do you do?
Couple things. So my background, man, I was a career fireman for a little over a decade, and accidentally started a software company. This was like mid 20 teens, right? In 2016, I think it was. And so, yeah, I had no plan to get into tech. I had no plan to be an entrepreneur. I'm not like a Stanford CS grad, VC, this or that. Like, I was just a regular guy, kind of squirting water for a living and having a great time in the fire department. And yeah, so I started a SaaS company with one of the guys on my shift partner, Jake. And he opened a CrossFit gym in his
Mhm.
hometown in Gettysburg, Pennsylvania. And I was like helping him with his website. I was kind of like a closet nerd. I was helping him with his website. We were setting up some email automations. And we figured out some stuff that really helped him grow his company, even though, we're spending 72 hours a week in the firehouse, riding fire trucks. So he's not like doing consulting calls and talking to new members and stuff like that. And so we had no idea what we were doing, man. We like put some content together. Jake went on a podcast, we gave it away. And I had this bright idea of like, let's do like an upsell offer where I'll set this automation up for 10 gyms and, maybe we'll charge $100 if we get 10 or 12 sales. That'd be cool. It's beer money, whatever. 100 gyms bought it in 3 days. And I was like, yo, I have no idea what I'm doing. And so like, it was so funny. We got all our buddies from the fire department. We like rented a conference room in the apartment complex I lived in. And we're like sitting around with our laptops, like setting up all these automations for these gyms. But that was like a cool moment. It was my first dollar on the internet moment, but also just like this realization that, wow, there's some real demand for, people getting help to set up their marketing for their gyms. And so that led to us, we partnered with Infusionsoft for a while and we built a bunch of stuff with them. But eventually it just needed to be its own thing. And so I went to coding boot camp on my days off from the fire department, learned how to code, and found the smartest guy in the boot camp and kind of bullied him into being our CTO. And we launched a company called Uplaunch. And then in 2017, we split from the fire department, went full time on it. And yeah, we were successfully acquired about a little over 2 years later in 2020. It was just a
Mm.
mad sprint to the finish line. It was not like a soft landing acqui-hire. Like it was a strategic acquisition that served a real need. It was pretty cool. And the timing was fortunate, I think, for our customers too, because you know the gym industry got crushed in a lot of ways weeks after we sold. And honestly, we were able to do a lot more for our customers and for our team by being part of a larger organization post acquisition who was weathering that storm together. Like it would have been really hard. We were 12, 13 people when we sold. You know, it would have been a lot tougher for us to weather that on its own. So I was super grateful, honestly, for the whole thing. It was a really good outcome.
Yeah. Had it been like a little later on, maybe it would have been Alex Hormozy who ended up acquiring you potentially
Maybe,
because that's
yeah,
like his whole thing. But
yeah. I don't know.
that's
Mad
that's a
respect for
cool
Alex.
story.
Yeah, it was fun.
I I love those stories where, people kind of throw something at the wall and then they're like, "Holy shit, this actually worked." Those
Yeah.
are like my favorite stories.
Well, it's funny because I think a lot of people, it's super tempting to do the whole revisionist history thing, right? Where I mean, there's 1,000 things we did wrong and we had no idea what the hell we were doing. And in the rear view mirror, you can always make it look like you were super smart and had all this stuff figured out. But the reality is, and it's one of my like mantras in life, is just next right move. Like that's all you can do to get something off the ground. Like you can build a strategy, had no idea if it's going to work, if it's going to survive first contact with a customer, if anyone's going to give you money to solve it the way you wanted to solve it. You have no clue. And people who say they have it all figured out are lying or naive. I was naive, but so it was just always that didn't work. Next right thing. That didn't work. Next right thing. This feature didn't work, or company didn't work, or idea, whatever. It's just what is the next thing I got to do to survive, to try to provide value for people to the degree that they're willing to transact with me. And like you just keep solving that problem and love the people you're solving it for. If you're smart, you'll figure it out eventually. But I don't know. I think the days of the 50-page business plan have come and gone.
Definitely. Yeah. And also in the times that we're in now too, the pitch deck, doesn't have that much weight either. It's just
Yeah.
like, what are your numbers? Are you profitable? Are you growing? That's like the
Yeah.
only thing that matters.
It's interesting, man. I think the landscape of venture capital overall is changing, and I think it's changing in a really positive way through a lot of lenses, because like it's a super useful tool for a specific type of company, right? But it's like using a sledgehammer to build, tap in a framing nail. Sometimes it's just a little bit overkill, and I think the second order impact of that is that there's a lot of companies, it could have been beautiful companies that are like in burning heap of trash on the side of the road because they couldn't achieve $1 billion outcome, right? And it's like it was just so counterintuitive to me that a company with a $50 million annual run rate is also a non-remarkable failure. I'm like, damn, like that's actually a baller company if it's structured differently. And so I think that the economic changes that are happening in VC right now are a net positive for the overall like creator ecosystem for founders, because I think it's still a great tool if you're building something that has a huge addressable market and you're going to need to, get into hyper growth and need that money. Like sick, that's the right tool for the job. But also like capex is coming down, the barriers to building are coming down. So I think that it's putting bootstrapping within range, or doing like a one and done round where I'm just going to get enough money where I can eat and go build this thing and get profitable real fast. Like both of those are great playbooks. I think they're within reach of a lot more people now than they used to be, which is awesome because you're going to have better outcomes for founders, which means better outcomes for customers and more smart people trying to build stuff. So I think overall it's a win, because I don't think VCs have a lot to gain from like having a lot more companies that probably aren't going to make it. Ideally, if they can focus their capital on the ones that have a higher likelihood of actually being a unicorn, that's going to be a better return for them too. So I don't know. I think things are pointing up in that case.
Beautifully said, man. I mean, summarize, it's like the current market conditions are forcing people to build actual businesses as opposed to rely on VC
Yeah.
and, kind of skirting profitability and, driving up valuations based on just hype pretty much.
Yeah.
So
It's funny. I haven't thought of this in years, but I said this all the time. And I like, again, no idea what I was doing in my first business. Like I didn't know how VC worked. It like raising was this anomalous concept. And I would read about all this stuff and read the articles and this and this and that. I would say out loud to my co-founders all the time, I'd be like, guys, this wouldn't work if we were running a freaking lemonade stand. Like, why would we do it here? And yes, that's a bit of a naive statement in hindsight, because there are definitely times when that playbook is warranted, right? But I don't know. I think a little more lemonade stand and a little less unicorn is probably a good place for the overall climate to shift.
Well, it's pretty interesting because a lot of the founders that we actually talk to, and I talked to Kevin about this yesterday too, and he is like, he's an enemy of this, but
Yeah.
we see it a lot. And what we see is the founder kind of comes to a precipice point in the business where they're like, okay, I'm kind of tired. I'm tired of like grinding the bootstrap. VC capital would be really nice just to get an injection and
Yeah.
infusion of capital to hyper growth the business. But at the same time, the other direction that I could totally go as well is just sell my business and exit and take my cash and my chips off the table.
Yeah.
And Kevin's like, I hate hearing that from founders. Either you want to sell your business and you want out, or you want to stay in the business and you want to take the capital and you want to take it to the next level. Just be clear with exactly what you want.
Yeah.
And the point there is that it's incredibly important, actually, that founders know exactly what they want, where they want to take the business. And this is actually to the point of sellability as well, in terms of knowing when you've hit that wall and when you're ready. Kevin has the annual exit planning process that he suggests, which is like a great kind of framework for people to know, okay, this is where we're going to this is where the train stops.
Yeah. Well,
So yeah.
it's interesting because I feel like there are a few different incentives at play in that example, right? And I agree with what you said. Kevin's viewpoint is right, where it's like it's a bummer to see a founder sell just because they're tired of doing the thing, right? Because I think that the right coaching and the right motivation, you can definitely build a business that you don't hate. We've done it a lot, helped a lot of founders do that. But I also think, like when you talk about stress, right? There's like acute stress that's in the moment and there's chronic stress that builds up over time. I think when you have a founder who's bootstrapped and, some of these guys are like cashing out retirement funds or taking out second mortgages on their houses or like going hard to build their business, right? And so when the only way that business meaningfully contributes to your net worth is like paper value upon a hopeful exit at some point, like the chronic stress of not realizing that financial game, I think really starts to add up over time and makes people more tired of running the business, because really it's like, if this whole thing goes away tomorrow, I've been at it 6 years and I'm making whatever, like an okay salary, but no real wealth generation. And if it goes away, I'm kind of screwed. Right. And so it's actually like it's interesting risk adjustment where the longer they stay in the business, the more risky it feels, because it's this whole mental thing of, oh, this whole thing could be gone tomorrow. And so I think that there's an interesting opportunity also for the market if, someone were to build an instrument that leaned more into doing secondaries for founders, right? Where they can make investments to like get some chips off the table. So at least it's like chump insurance almost. At least the founder can be like, okay, I'm not going to be left with nothing if I play a little harder and push a little farther and stay in this game, because I was able to at least take some chips off the table in exchange for, reducing my outcome further downrange. But like that, I'd love for that to be an option that more founders have within reach too. Because I mean, if you can take, 5 or 6 years into a business, take $1 million or two off the table and your family's like, cool. And you're like, I can breathe, I can eat, I'm not freaking out again. Now I'm going to go swing for the fences. Like that might be a viable model too. I just haven't seen it done too much.
Yeah, that's true. I mean, I was going to say, obviously not the same thing as secondaries, but oftentimes founders will get acquired from a strategic investor. So, a strategic investor will make the initial strategic investment, and then that strategic investor will oftentimes end up acquiring the target that they invested the strategic money into. Obviously not the same thing, because they don't get to take the chips off the table in the same way in terms of, selling their interest in the business and actually cashing out. But at least they know, like, okay, we're going to take this investment. This person wants to acquire us, and the pathway becomes that much clearer for that founder to know that there is a light at the end of the tunnel if they continue to push just as hard, so on and so forth.
Yeah.
I think that's the benefit of that is the other side of the pathway when founders are like, "I'm tired, but I totally would take this VC money, because that actually feels very supportive and, it actually can help me in a lot of ways so that I don't have to grind for the dollar and try to figure out where in the budget we're gonna allocate things. I have this extra reserve of cash that I can
Yeah.
actually do the things that excite me."
Yeah.
I
It's
love
tricky,
the
man.
point around secondaries too.
Yeah, it's just tricky. I think the complicated thing with that, and I think like the commonly accepted narrative around that is that if you make the founder less hungry, they're going to be less motivated to work hard and they'll go on cruise control and so on and so forth. So I think that the behavior that change in incentives drives is actually the real problem to solve, because I think finding a good business to invest in is still finding a good business to invest in. It's just where does the capital go? Does it need to be in the business to grow the business? Can it go to the founder to help keep them in the business? Is that actually a net add? I don't know. It's a really complicated intersection of like economic factors and behavioral factors, but it's I don't know. It's one that's worth somebody solving, because I
Do
think
you
that
think that's true?
it's a good question. I think that it can be true. I think that money changes a lot about a lot, right? And so I think that there's ways that it could be true, there's ways it could not be true, and I think that the differentiator between those is to some extent maybe the depth of the secondary investment, but I don't even think that's as material as just the character of the founder, right? It's the stuff that you can't evaluate at scale. It's almost like doing pre-seed investment, like you're betting on the person more than anything else, because the whole thing's going to
Mhm.
change 20 times. And so I think that if I were to be building a vehicle like that, the biggest problem to solve to me is figuring out, like, is this somebody who needs a sigh of relief so they can chill and like care less about the business than they do now, which would make it probably not that great of an investment? Or is it somebody who wants to make a more aggressive bet on the market, but feels like they can't justify the risk of making that bet because they're more likely to lose everything if they go hard? That might be a better one. So
Mm.
I don't know. It's candidly, I haven't put a ton of thought into this. It's just one of those things that it kind of comes up when I remember, and I mean, I was only in the game, my first company, a couple of years, it wasn't as long as some of these guys doing 7, 10, 12 plus years in a business. Every month, dude, I was terrified that something would happen and it would all go away tomorrow. And also, granted, first time founder, I was in the fire department, like just working for a county government, and over here I'm talking about a company doing millions of dollars in revenue, and like the whole thing was an alien concept to me. And so I was in constant fear that it was going to go away. But were there bets I could have made to grow that business more aggressively if I didn't have to reconcile and wrestle with that fear? Absolutely.
Mm.
So I think there is a type of founder that it would work really well for. Finding that person is the key.
Yeah, and by the way, there are a bunch of platforms that have, like, cropped up over the years where you can go sell secondaries.
Yeah, that's cool.
I can't remember what they're called right now, but I've definitely seen them in, like, a bunch of the different newsletters. Like, I think Last Money In was one of the newsletters that I saw one of them in.
Ah, that's a great name.
Um,
Last money in. That's like the whole thing we're talking about, right? Just get like
yeah.
raise the one round, get to profitability, rock and roll. That's a great name.
Yeah, it's a VC newsletter. They're fantastic. Highly recommend, checking them out. They're super cool.
Sick.
But, cool. So that's a little bit about your background, Matt, and what you do now. You're COO of SaaS Academy, is that right?
Yeah, yeah. So we're a training and coaching company for B2B SaaS founders. We basically pair founders up with executive coaches, expert coaches in different disciplines. We've got like 300 plus highly vetted growth playbooks that we've used in our own companies and in thousands of client companies, run in-person events, build community, kind of the whole 9 yards, man. And it's funny because I found SaaS Academy as a client when I was running my first company, Uplaunch. Like, again, I had no idea what I was doing. That's probably the title of this episode, right? And this dude has no idea what he's doing. And I had hit like an 18-month revenue plateau and couldn't figure out how to break it, and joined SaaS Academy because I was pretty much like, if I don't change anything, this business is going to fail. If I
Mm.
hire a coach and it doesn't work, this business is going to fail. So I might as well hire the coach and see if it works. And so I joined SaaS Academy as a client in 2018 and used the playbooks in there to break through the revenue plateau that I couldn't figure out and grow. And we grew every single month from like 3 months after I joined until the day that we sold.
Mm.
So yeah, it was really cool. And then I linked up with Dan. We did some investing and acquisitions for a little while, and then pivoted to help grow SaaS Academy. So yeah, that's where I'm at now.
Right on, man. And when did you start building your company as a sellable company? Was it when you joined SaaS Academy or?
It was like 6 or 7 minutes before we sold, roughly. It's a complicated answer. There were certain things that I think we did really, really well. There were other things that we literally had to do, like, during due diligence to sell the company because I just didn't know what I didn't know. I just had a bunch of blind spots being new. So there were some things that we hit well or some things that we didn't.
Even when building a sellable company, I think doing everything that's gonna make the company sellable probably isn't that feasible. There aren't that many entrepreneurs that, like, check every box, but,
Yeah,
checking at least some of the boxes, the major boxes are incredibly important. So let's talk about the 3 things that make a company sellable.
cool. Came up with this like 5 minutes before we started recording. I was just trying to get my thoughts on paper. But the 3
Are you gonna be
big
able to
things.
read your handwriting?
Hell no. Oh my gosh. I screen share this thing. You guys can be like, "What is this guy doing?" Might as well draw pictures, honestly. So, or the 3 things, the first one, and this is the first one here where I think we did a decent job in certain areas early on. But if you're sequencing these, this is the first one to tackle, right? Which is durability. When someone wants to buy a company, they're looking to buy durable revenue above all else, or if it's a financial acquirer, durable profits. But they don't want a business that is vulnerable to a variety of external factors that can make it go bad after acquisition. Because already, like something like 80% of acquisitions don't go according to the plan, don't provide the financial upside that the acquirer wanted it to. Like it's already a tricky growth strategy. When it works beautifully well. It's kind of like investing. Like a lot of the time, it's not going to work. And so durability is a big thing that acquirers look for. And so a couple of things that I think are maybe not obvious or were not obvious to me at the time. One of them is around customer concentration, especially if you're selling like high ticket deals, you're selling to enterprise, selling to healthcare, government, education, things like that. Like if you have customers who are driving 30, 40% of your recurring revenue, like from a single account or a single very tight segment of an account, that's a higher risk profile than if you have a more diversified set of customers, you know? So that was one where in our first company, we did pretty well because, we were working with a lot of independent businesses, they were all relatively equally valued, which was cool. So that's just something to take a look at when you're thinking about your go-to-market strategy. It doesn't mean you can't do big deals. You should be doing big deals, but like if you have one company that's funding half of your revenue, that's not a great thing if you're trying to sell. So try to
Yeah.
diversify a little bit. So that's one. I think the other one, and probably the most important one, honestly, is putting yourself in the shoes of an acquirer and looking at like what are the expansion opportunities that could be unlocked post acquisition. Now, the funny thing, going back to what we were just talking about people and like their mindset, is that the follow on question to that is, well, why the hell can't I just do this stuff now and build a bigger business, right? So that's always the follow-on question. Like, the private equity playbook, they buy a company, they do cost control, they raise prices. Like, you could probably do those things and just have a business that makes more money. But regardless, I think it's important to put yourself in the shoes of a potential acquirer and say, like, if I didn't own my company and I bought my company from me today, like, what are the 3 or 4 things I would change straight away? Like, am I neglecting my pricing because I'm like emotionally scared of raising prices for customers and I blah, 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 blah. Like pricing and like head trash is just, it's crazy how tightly it correlates. Right. So like, am I doing that? Do I not have the right plan levels to try to encourage expansion? Am I not driving my pricing on the right value metrics? Just like thinking through what people would change and having a good idea on like, is there a true opportunity to make your company more valuable post acquisition? And then if you don't sell, you should go execute on those things and make your company more valuable. But either way, it's a really helpful frame, I think, to look through things and see like why would someone really want to buy this? If, especially if it's a strategic where they're thinking about like, let me go integrate it with another market. Let me go make some improvements. Let me go tie it into my platform. I would have a good narrative around that because I didn't have that in my own process and the people who acquired us did, which was cool. But like, I didn't have a whole idea around this is why it's a great idea to do this economically. I was just trying to figure it out as I went. I could have done with a little more thought work there. And the third
Mhm.
part on durability, man, is like owner not needed, especially in
Yeah.
your marketing and your delivery. Like if it's if it's mattverlack.com, like that's not that cool for someone to buy because Matt Verlaque's gonna try to leave and then you're left with I don't know what. So like making sure that you're not needed, getting your leadership team built out when your company's at the appropriate stage. If your marketing is very dependent on your face, trying to shift it from being personality driven to methodology driven or outcome driven, I think is really important. So yeah, man, I think customer concentration, post acquisition opportunity, and like what can you execute on, and making sure that you're not the choke point. I think that's kind of that first part of durability, and all that stuff can start super early.
Cool. Let's dive in a little deeper on those. So with the first one, customer concentration, one of the things that I heard you mention was making sure that your business isn't concentrated, for example, especially with like enterprise customers, like you have one or two very large enterprise customers,
Mhm.
multiple 6-figure, 7-figure deals potentially. And that's where the majority of your revenue comes from. What I hear, obviously, is people should have diversified customer concentration. So not only lots of different contracts, but I would also imagine multiple different channels of acquiring those customers as well.
Yeah, I would say the first part's more important though, right? Like I don't see anything wrong with centralizing and going deep on an acquisition channel that's really, really working well. But especially I look at it more from a revenue retention risk than anything else, right? Where like if X customer left, is my business 40% less valuable overnight? Like that's the real risk that I think people are looking at. And like I said, it doesn't mean don't chase big deals. It just might mean go get more of them and try to grow through that, or try to surround it, with some mid-market deals that can help give you some revenue that might stick around a little bit longer, because just your risk profile on that one customer is just super high. Or just understand that you might pay a penalty on your valuation to compensate for the increased risk.
And as you are part of an organization that helps SaaS founders address these specific areas, what is it? Is it fear of the founder? Is it that they get comfortable, that they don't like, that they don't go just get, what I hear is just go get more customers. Like you have one or two very large customers, or you have, a few large customers. What's keeping them from actually going and getting more customers?
It's I don't know, it's very specific. I feel like it's interesting. There's a couple of different archetypes if I put a second of thought into it, right? Like one situation where I see concentration risk happen is that a company will start to solve a very specific problem for a very specific large company. Like maybe they were consulting for a specific company or situations like that. I'm going to work with this specific food franchise or this specific hardware franchise or whatever. And they build their solution that's very, very driven on that one account. They do a really great job getting inside that operation and expanding within that operation, and the rest of the market expansion is sometimes an afterthought. So, like, that's one place where it can happen. Yeah, I don't feel like people aren't motivated to get deals. I just think, honestly, it's something that is like not all recurring revenue is created equally. I say this
Mm,
often, that not all revenue is created equally, right? So you definitely split out your recurring and your non-recurring, because people who are buying software, who are true software acquirers, aren't going to care that much about your, transactional revenue. But even within that, the recurring revenue is not all created equally, right? Like if I'm getting $1 million in recurring revenue from 500 different people, that's more valuable revenue than I'm getting $1 million in recurring revenue from 3 different people, right? Because it's less risky for one person to get pissed off and leave. I think it's just a mindset to be aware of, where you need to do one of two things. You need to really triple down on growing those enterprise accounts to try to diversify them, or you need to also have a mid-market approach where you can get more accounts that try to make up a more meaningful segment of the revenue. So I don't know. I don't think it's that people don't want to grow. Honestly, I think it's just people that they hit a certain revenue level and start exploring acquisitions and then not understand why it's not that attractive to a buyer, right? Which then they're playing a little bit of catch up.
yeah. Well, I mean, that was also one of the problems that you had experienced in your SaaS company, right? You hit a plateau in your SaaS company, and then you started looking for solutions in terms of how to overcome that revenue plateau that you had hit, right? So you had kind of hit your ceiling of growth in the business, maybe not in the same way in terms of having customer concentration solely in one place, different customer base. Like it's
Mhm.
for you, it's not going to be so much enterprise, like it's actually like
Yeah.
smaller gyms. So for you, customer concentration is going to be less of an issue because you actually need to acquire more of these little gyms. So you're
Yeah, dude, we
like,
had the opposite problem that drove our plateau. Like, we hit our plateau before we decided to stay focused on gyms. Like we built our minimum viable product on gyms, went to market, and immediately said the most dangerous words in entrepreneurship, which is, holy shit, this could work for everyone. So then we started selling it to this market and that market, any brick and mortar business that has a membership base and blah, 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 blah. And all of a sudden we were for nobody. And we were a tool competing with a bunch of tools, but we were 6 times the price and nobody got it. And as soon as we went back to saying we help gyms find their most loyal members and this is for you, like the tighter you specialize, the higher your perceived value is. And so we niched back into what worked. And 2 of the people on our founding team were CrossFit gym owners. So we also had the authenticity there. Magically, we started growing again once we got back in tune with our ideal customer. So we were the opposite problem where we got a little too big for our britches a little bit too early on and thought we could build this wide ranging thing that everyone would get. And they didn't get it, but our people did. We just had to tighten it back up.
Yeah, it's interesting that you went back. You went back to what worked. It was like, well, this worked,
Yeah.
so let's just go back to that.
Yeah, dude, it's something we teach constantly in SaaS Academy. We call it the scaling credo, right? Where it's, we tell people to focus on one customer with one product, one like go-to-market channel for 1 year and just go hard on these things and like have a very high bar for what it means when you say like, oh, this won't work, because a lot of the time it's a small tweak or an execution issue, right? That's actually standing in between you and your progress. And so I think to go from 0, I mean, we were at like, I don't know, 15K in monthly recurring revenue when we hit that first plateau. I mean, you can brute force a company to 15K in revenue. It's not easy, but it's not that hard, right? And like, but we couldn't figure out how to turn into a real business. So to try to go industry agnostic, super wide that early when you're not raising cash, it's not a good playbook. It's the hardest one in the book, right? And so
Right.
for us, like we had to tighten it back up. And it was that training that I got from SaaS Academy as a client. And I was like, all right, like I'll try this. I don't know if I agree with it because I feel like I'm limiting myself, all the stuff we say to ourselves.
Oh, it worked before.
Yeah.
Like,
Well, it's funny because I think founders, dude, this is actually really important. Like founders have this altered sense of permanence on the decisions that they make. When you talk to someone about picking a niche, some of the most common advice out there that I was just saying that we needed to unlock growth. Tell them about picking a niche. The most common rebuttal you hear is, but it could work for more people than just this. I don't want to limit my growth. You're not getting married to the niche. Like you're not chiseling it into stone. You're saying, I'm going to achieve my initial growth, my beachhead market with this customer segment that I know incredibly well. And when I have a business, then I can make strategic pivots out into the adjacencies, right? So like the 1 year thing is really important on this, where it's not forever, but it can be one of these things where you try to go too wide, you won't get anywhere. You won't have anything because you won't grow at all. It's just we feel like all our decisions are permanent. It's crazy.
yeah. And it's also like, well, that mental model also doesn't necessarily work either, because it's like, okay, you choose that one market, as you said, then you just choose another market, you go into that market. There needs to be a strategy for each one anyway. And
Yeah.
it needs to be like fully executed in that strategy. And it needs to be almost like the scientific method. The hypothesis needs to be proven. Once the hypothesis is proven, you have the systems in place, then you can start to scale out to other markets. But in general, you never want to go like, we're for for everyone. Like it's
Yeah.
going to be other very specific markets and niches.
100%. And the whole thing is a continuum, right? Like if you have product quality on one side of a continuum and personal expertise on the other side of the continuum, right? Like you're an attorney, right? If I was a badass attorney, 40 years M&A, done a bunch of crazy deals, I could sell you some shit written on a paper towel and a crayon. And like, if I had a great talk track around how it would let you be the kind of attorney that I was, you'd probably buy my paper towel, right? I'm not an attorney. I come put the same paper towel in front of you, you can wipe your face with it and be like, thanks, man. I'm good. I have a crumb. Like, I'm good to go. You're not going to care at all. Right. So it's like when you have personal track record and personal expertise in a market, you can build alongside your customers and subsidize the fact that your product might not be that good yet with your expertise and the fact that you've walked the walk and that you really care about them and that you can teach them how to build a better business. But then when you pivot into the adjacencies and you've never done the thing that you're trying to get someone else to do in that market, your product's got to be a banger at that point. It's got to be
Yeah.
really good, and it's not going to be good if you're at 15K in revenue trying to figure out how to run a team. So that's a
Yep.
big part, I think, of why the beachhead market strategy is a great strategy for people who aren't raising money. It's because it gives you something where you can subsidize the fact that your product might be a little rough with your personal experience, your personal expertise, your track record, your reputation, working for a market that you really, really know.
You said the beachhead marketing?
Beachhead market. Yeah. So like it's adapted from a, the military strategy, right? Where you have like a beachhead where you capture the beachhead, fortify it, and then branch out. It's the same exact thing
Gotcha.
in business, right? Where you have your
Yeah.
one market, do a really good job selling to gyms or selling to lawyers or whatever it is, and then say, okay, like, got this, we're cool, we're secure, I got revenue, product's dope, I know what I'm doing. Who else could this help? Let me go put some resources behind an actual cohesive strategy to go do that thing.
Cool. What made you choose customer concentration? And let me tell you about the context for the question. I love
Sure.
stories. I think stories are a really great way, case studies, stories are a really great way to get a point across. And
Mhm.
so was there like a specific scenario, maybe something that you've seen recently? You don't obviously have to name names or anything like that, but what was it that made you choose customer concentration as like one of the first things on the list?
I was helping someone navigate a potential offer on their company, and they'd been in business for a while. Is an older person. They'd been running their business for quite some time, kind of ready to potentially do something else. All good. Solid business, good revenue. Couldn't figure out why the buyers weren't putting up the valuation numbers that they were expecting in any of the discussions. And it
Mhm.
was like 46% of their revenue was coming from one key account. And that was a huge concern for the acquirer because it was a key account where like this guy had spent better part of a decade cultivating that relationship. So again, owner not needed. If the key relationship that unlocks the account that's driving roughly half of the revenue steps away from the business, what happens to the key account 1 to 2 renewal cycles down range? It makes and it's not unreasonable. Like anybody putting that kind of money up to buy a business, like you want to protect the asset that you're buying. And so it wasn't unreasonable. It was one of these things where this particular person hadn't considered the fact that that account, which they'd put a ton of time and effort in over the years, growing and expanding and cultivating, and it's great business, but that thing that was a positive for them, owner operating the business, was actually a vulnerability in an acquisition discussion. And that was like one of the first times where I saw it show up to someone personally. Cause again, like this wasn't something that had to deal with in my own company because we were very well diversified. Almost all our customers were the same. Right. So, but seeing that has such an impact to the point where it made this person materially less likely to exit their company simply because there was such a valuation mismatch between what they thought it was worth and what an acquirer thought it was worth. And the main reason was because of this key account risk. I can't like unsee that, right? Because that's something that would take a couple years to build your way out of. And if it was something that that person had on their radar 5 years prior, it's not that you don't cultivate that account and expand it, but you realize it and say, okay, this is going to be a risk when I try to have this conversation. Let me go work on expanding some of these other accounts or so on and so forth. So that's why it's on the list.
Yeah, so did they end up doing what they needed to do to raise the valuation, or did they just take that lower valuation?
They didn't exit as far as I know, but it was, I don't have like knowledge exactly of how the story ended. I was
Gotcha.
helping someone in the specific conversation.
Cool. No worries, man. I was just
Yeah, all good.
I wanted to know
And
how the story
I'm kind of curious.
ended. If I had to guess, I don't know. It sounds like maybe they took the lower valuation. That's my
Well,
guess,
I
but
don't know. We'll
I don't
have to
know
leave it
either.
for
I'll
a
have
mystery,
to,
man.
yeah, I guess reach out to Matt, after this show, and he'll
Oh,
tell you
yeah,
the
it's
end of
funny.
the story.
Yeah. It's funny, man. I just feel like it's one of those non-obvious ones. There's a lot of ways to grow a company, and this is one of those ones where you can do a great job growing, and then it gets tossed back at you and be like, actually, we don't love this. And you'd be like, damn, I didn't have that on my bingo card, you know?
Yeah, I mean, we have seen it happen actually where, yeah, massive customer losses. And obviously, there's built-in protections in the purchase agreement for buyers, for adverse changes and so on and so forth
Sure.
for periods of time. But that's just not a position that a buyer would want to be in anyway.
Yeah.
And so as a seller, yeah, the benefit to you is you work on this. you get a higher valuation, you get happier buyers, and so it benefits you as a seller specifically to focus on this, and think about it. Do audits of your customer base and see where your customers are coming from. If you're not already doing this, I would imagine that you are, as a founder. I would imagine you think about your customer base quite a lot. So
Yeah.
thinking about where the concentration of where they are, where they come from, and diversifying it is important, as Matt's pointed out. And so that's the takeaway here.
Yeah. Yeah, for sure. We hit the other 2 points quick if you want.
Yeah, let's talk. So the second one was expansion vision. Is that right?
Yeah. All this was kind of couched under just building durability. But yeah, so knowing the expansion, like the expansion opportunity post acquisition, definitely important. Like, what's the playbook that you think they would run? Yeah. And then getting yourself built out of it. But yeah, those were the
What
three
came
for
up for me
durability.
for the second one with that expansion vision too, if it is maybe moving into another market, or, there's an aspect of the expansion vision that actually leads to potential strategic acquisition,
Hmm.
in
No
terms
doubt.
of, it's like you have this vision for expansion or this plan for expansion. You could start going out and, meeting with those potential relationship partners to expand into that market. And if they are enterprise, for example, those are actually perfect strategic investors in your business that could actually end up being acquirers. And so that, like,
Yeah.
killing two birds with one stone in that way makes things more efficient.
Yeah, no, 100%. I think that like a partnership strategy is a great way to kind of feel this out, right? Especially if you're doing partnerships with larger companies. Some of these companies have funds will they'll do some of these strategic investments. So like there's a clear through line from integration partner, strategic partner, potentially a growth investment to an acquisition, right? There's a
Hmm.
clear through line there. And I don't have any data around this, man, but I would imagine that a non-zero number of acquisition discussions start out as partnership discussions.
Yeah. We have one client we're working with right now that
Mhm.
it actually, from the very beginning of the conversation, was like, okay, we're going to do this. We want to test out your tech. You have a great opportunity for this sector of the market that we've been wanting to tap into, but our tech is too expensive, too bulky, so on and
Exactly.
so forth. So your tech is lighter, less expensive, more suited for this mid-market. What we'll do is we'll take our sales team, we'll sell your product for a percentage of the profits, with the understanding that down the line we might help you grow further, make an investment, but what we really want to do is acquire you.
Yeah.
And they've had that conversation like from the break.
That's cool. It's nice when everyone's upfront with their intentions. It makes the conversations a lot easier. Now that's super cool to be able to have that conversation. It's funny, there's a company that we were working with we're a customer of theirs. So they're called Arrows. They do like user onboarding flows, but they're specifically like user onboarding for companies that are on HubSpot. And so that's always been, I don't even know the founder personally, but his product is dope. But like, so we use it. It integrates really, really well with HubSpot. But then I saw a release. I was just pulling it up where they kept doubling down on their partnership with HubSpot, and then HubSpot Ventures made investment into their company. And so he's like, all go all the way team HubSpot, which is great because HubSpot's platform is massive. But like, I wouldn't be surprised if that company ever gets acquired. I'm pretty sure I know which big orange company is probably going to be number one on the list, right? Because their onboarding flows are great. So yeah, I think it's an interesting thing of just like tripling down on a partnership with a company that could have the potential and capital to acquire you. It's a cool strategy for future planning.
Totally. You're just a value add at that point.
Yeah,
And if
no
you
doubt.
focus on being the best value add that you could be, then it's like you're driving your value to that business.
Yeah.
I've been in the startup world for a long time, and coming across founders for almost 10 years now, where every founder obviously kind of looks at the exit, admires the exit.
Mhm.
And so many founders are often like, from the very beginning, they're like, oh, yeah, I'm going to build this business and we're going to get acquired by XYZ. Like, the vision for acquisition is there sometimes from day one.
Yeah.
And I think there is something that's valid to that. It is good to have the vision of who your potential acquirers are and to always be thinking about who those potential acquirers are. Now, there are obviously founders that from day one they build the business and they're like, Google's gonna acquire me. That's totally different than actually being thoughtful in terms of who the acquirers are, building those potential relationships, thinking about how the product integrates, how the product could actually add value, and testing that hypothesis of who you think that potential acquirer could be.
Yeah, I feel two ways about this, right? I think that doing everything you said is a good idea. But the part that gives me pause is, and this isn't the majority, right? To be clear, but there are some founders who will start a company with the sole intent of, I want like my only fulfillment or mission from this company is to get acquired by X. And it's not that it can't work. It's just that it's statistically very unlikely to work, right? And so
Yeah.
I think that that also puts the founder, which means it puts the team and the customers at risk of that company losing steam a lot more quickly than it had to. And so I think that I agree that it's good to think about who your acquirers could be and build partnerships with them and do all of those conversations. But also, it's just not a good reason to start a company, I guess is what I'm trying to say, right? Like, start the company because you're in love with the customer's problem that you're trying to solve.
Yeah.
Everything else is mutable, right? Everything else can change. The way you solve it might change 100 times. Who you think your acquirers are might change 100 times. You might run it for a year and pop off a sale. You might run it for 20 years, get profitable, cash flow. It's a platform for your whole life. It's who the hell knows? So I love the thought work behind it, but I don't know, man. I'm just like, if there's anyone listening who's like about to start a company and they're like, I'm going to start this company, sell it to Google. Like, there's a whole lot of shit between here and there that has to go right for that to happen. And you'll have a much better time if I'm going to start a company to go solve this problem for this person because of these reasons. Like, that's the formula. Everything
Yep.
else will happen if you do a good job there.
Yeah. It sounds like you may have heard some founders say I'm gonna start this company and sell to Google a few times as well, is what I'm picking up.
Refreshingly, dude, not as many as you would think, or maybe those just aren't the ones who come get coaching. I don't know, but yeah, it's really, I love what I see in the market right now with founders. Man, I talk to a lot of founders, man, and what I see overwhelmingly, and granted, my view is not representative of the entire SaaS market, right? I mean, we work with probably 75% bootstrappers, so yes, my view is pointed that direction. But what I see is more people with a specific expertise or a specific skill set around the problem and a specific passion for a specific type of customer building software to make their solution for the problem go faster. Like, I hate the acronym SaaS, right? Software as a service, because honestly, to me, it's service as a software. Like, we forget that the service is actually
Mm.
a thing. Like, we're trying to solve a problem. Software is a box truck, man. It's a delivery vehicle that lets you get your solution from point A to point B faster. Like, the software is very rarely the actual innovation. It's the outcome that you're providing. And so, like, what I see happening in the market more than anything else is that people are using the fact that the technological and financial barriers to building software are coming down. They're using that to their advantage to deliver their solution a hell of a lot faster, more cost effectively to more people in half the time. And like, that was the whole reason SaaS came about to begin with. So I almost feel like it's a resurgence of like getting back to what was, right? Which is like, I solve this problem for people, but I can't go fast enough with my hands and I don't want to hire a whole team. So I'm going to use technology to fill the gap, right? Like, it's a great plan. It works really well.
I love that everything that you just said, I 100% love that. The service mentality is incredibly important. One of the big challenges that early stage startup founders have is they build a product that the market doesn't want,
Yeah.
right? So
Cardinal sin of
thinking
product management, man.
yes. So like thinking about it from a service perspective as opposed to a software perspective, that simple framework actually solves that. It's like, how can I make sure that this service is actually, it's not about the software, it's about the service. Are you serving people? Do they want this service?
Yeah.
The software is just how the service is delivered. Love that so much. That was perfect.
Boom.
Yeah.
It's just, it goes back to a bigger principle, which is like, the things that it takes to win are not sexy. Like, it's not some new whiz bang framework thing or whatever. It's, I just got to go figure out how to make this person's problem go away and make sure that's valuable enough where they'll give me money for it. and everyone feels good about that. And then I'll go build some software to increase my margin and speed on fixing that problem. Like, it's not new. We just kind of, I don't know, maybe we lost our way for a minute, but I think we're getting back there, which is neat to see.
All right, so for the last piece of the show here, for the last few minutes, let's touch on that, the making the owner working themselves out of their job, making themselves obsolete to the business, having the necessary systems in place so that it's not owner operated. What do people need to know about that? What can you tell people that would help them?
A couple of things, right? I think that like the vulnerabilities that I see, if you're still in founder-led sales and you're the primary person closing deals, that can be a little tricky. So if you're a sales-led company, I would love to see people with a track record of having someone other than the founder slash CEO close deals. Doesn't mean you step out of sales. Sales and product management are probably the last two things you step out of when you're scaling an organization, right? You don't have to step all the way out of it, but if you're closing every deal and you're a company of size, that might be a little bit concerning. If you have an audience and the entire go-to-market strategy is based around your audience, that's another one that can be a little tricky, right? So like just think through what is the message I'm putting out to the market. If it's about like, come talk to me because I'm Matt and I know X, Y, and Z, like tough to replicate that one when Matt's not around after you sell the company, right? So it should be based on a methodology, based on client results that you get, based on the way that you do business to go solve this problem. I think like your message to the market is really important. And just to finish out this on the top end of the revenue funnel, just having a repeatable process that ideally doesn't require a ton of manual touching from you as the founder who would hypothetically be stepping away, I think is important. So that's where I look at it there. I think that it's not that it's less important on the like delivery side. It's just that's the part that people usually put on Rails first, right? I mean, we've got software to do the product. Most founders aren't like, my zone of genius is support tickets, right? So they're probably hiring customer support and people to help the back end operation run. It's usually the things that the founder clings to are getting deals done, being the face in the market, and sometimes being the product visionary. So I just think that, again, size appropriate, getting your leadership team stood up where there are people who can have higher standards than you have in each of their respective areas and push the ball forward based on the merits of the organization and the product instead of just based on who you are as a human. Like that's kind of the Cliff's notes on what you should be looking for over time.
Awesome, man. Well, Matt, it's been a real pleasure having you on the show.
Yeah, thank you, man. I appreciate the time. It was a fun jam session, dude.
Yeah, I always love jamming. This is like anything SaaS, software, startups, VC, exits. Those are my passion that I love chatting about. So always a good time. Glad to have you here. Everyone out there, make sure that you follow Matt Verlaque, COO of SaaS Academy, badass entrepreneur with an exit as well. And as always, follow, subscribe, like, comment, leave your takeaways in terms of what did you get from this episode? What was something that you got from this episode that hit you, that you found interesting, that you thought was important to note? What are you taking away that you're going to implement in your business? Super curious. Make sure you reach out, email Matt, reach out to Matt, follow Matt on Instagram and his socials. Everything will be in the show notes below. And if you got something from this episode, would love a 5-star review to show your support for the episode. And as always, make sure and tune in next week. Thanks, everyone. And thanks, Matt.
Cool. Thanks, man. Appreciate you.
Ciao.